What is monetary policy coordination for inflation? Have you ever wondered how countries work together to keep prices stable? That's where monetary policy coordination for inflation comes into play. This concept involves central banks and monetary authorities from different nations aligning their strategies to manage inflation effectively. The goal is to maintain price stability on a global scale, which is essential for economic growth. At its heart, monetary policy is about how central banks influence the economy. They use tools like adjusting interest rates and conducting open market operations. When inflation rises too high, central banks often respond by increasing interest rates. This action helps to lower demand and slow down price increases. Conversely, if inflation is too low or the economy is struggling, they may lower interest rates to encourage spending and investment. Why is coordination so important? Well, decisions made in one country can impact others. For example, if one nation tightens its monetary policy while another eases it, it can lead to volatile exchange rates and economic instability. By coordinating their policies, central banks can help stabilize inflation expectations and reduce uncertainty in the global economy. Monetary policy coordination can take various forms. One way is through sharing information and economic forecasts. This helps central banks understand global inflation trends and potential risks. Another method is aligning the timing of policy changes to avoid sending mixed signals to the markets. Central banks also work together to respond to global shocks, such as sudden spikes in commodity prices or health crises. These events can affect inflation worldwide, making coordinated responses essential. Additionally, coordinating with fiscal policies can ensure overall economic stability, as monetary policy alone may not be enough to control inflation. Effective coordination requires transparency and a credible commitment to inflation targets. Sometimes, central banks may need to use unconventional measures when traditional tools are not sufficient. Balancing domestic inflation goals with international effects is also a key challenge. Global economic forums and institutions play a vital role in facilitating this coordination. They provide platforms for dialogue and policy alignment. Recent experiences with inflation surges have shown that coordinated monetary tightening can prevent inflation from becoming entrenched. In contrast, uncoordinated responses can lead to prolonged inflation volatility. In essence, monetary policy coordination for inflation is about central banks working together to keep inflation rates stable and predictable. This cooperation supports economic stability and growth while minimizing risks associated with inflation and exchange rate fluctuations.